think we now have a little bit of better understanding, in terms of what led to the collapse. For example, we now understand better that the incentive systems were broken and they needed to be fixed. Also, we learned about, the savings glut that was there in a lot of emerging markets, which led to a flow of funds to the United States, which created some sort of a bubble.
There's been a big refinancing of the banks. There's been some work on the structure of the banks. So some significant progress there.
I think there's been a lot of progress made towards detecting signs of insolvency or liquidity problems and working towards an orderly resolution of those problems. And COCOs are an example of a mechanism that's being introduced in Europe especially to address those issues.
The US has moved with the Dodd-Frank Act and some of the other things that ensure that that lenders or originators have actually some sort of a skin in the game. Don't know how much progress that is, how effective it is, but US has moved on that.
We made progress in terms of using standard leverage ratio as a criteria instead of only relying on risk-weighted leverage, which has a lot of problems, mostly because banks used flawed internal models to evaluate risk.
I think we've made progress in understanding the causes of bank failure, and I think there is general agreement we must make banks safer. And one way, and one crucial way of making them safer, is to have more capital. That is more equity capital. That is essential to get taxpayers off the hook.